Now that we have completed our financial statements, we're going to move on to our closing entries. We close our temporary accounts at the end of every accounting cycle to reset our revenues and expense accounts. So at the end of the accounting cycle, we close out our revenue, our expense, an income summary account, which is a temporary account we only use during the close, and the withdrawal account. And we close them out with 4 journal entries. So we're going to talk about them here. You want to use your adjusted trial balance. We have the steps that we're going to complete down here, and we're keeping track of a couple things in some T accounts over here so that we can use them. So the first step is to close the revenue accounts to the income summary. Well, let's take a look at your revenue accounts. Service revenue is a credit. How would I close out that service revenue account? I would have to debit it. And if I debit my service revenue, I'm going to credit my income summary. So step number 1 is complete. We've closed out our revenue. Our revenue, once this transaction is posted, will now be 0. Step number 2, close the expense accounts to the income summary. So you want to list all of these expense accounts in your journal entry. Your expense accounts currently have a debit balance. I'm going to have to zero them out or close them out with a credit to them. So I'm going to list them all in my journal entry with a credit. I am going to total them up, and that total is going to be my debit to my income summary account. So what I've done as we've moved through these transactions is posted those transactions to my income summary. And my income summary does exactly what it says it does. It summarizes my income. So do you recall what our net income was on our income statement? $485. Notice the ending balance on your income summary. It matches that amount on your income statement. So step number 3, close the income summary account to the capital account. So my income summary, we were calculating our balance as we go along, is $485. Now that is a $485 credit. So to close it out, I am going to debit it. And I am closing that out to my capital account. So I am going to credit my capital account by $485. So I've closed my income of my company to my capital with a credit, and my capital increases with the income my company has made. In the last transaction, we're going to close out the drawing account to the capital account. So let's take a look at the drawing account. The drawing account has what type of balance? It has a debit. How would I close that out? I would close it out with a credit, and I'm going to close that out to my capital account. This a little bigger so you can see it. So now my drawing account is closed to my capital. So let's track your transactions into your capital. We had $35,000, and then we debited or credited it for another $485, and then we're debiting it for the $400 withdrawal. So if we take a look at that ending balance, add up each column, subtract out the smaller column, I'm going to end up with $35,085 in my capital. And if we go back and look at our statement of owner's equity for the month ended March 31st, 2015, our ending capital is also $35,085. So you can see as we move through the accounting process how all of these items tie back. Now, once you complete your closing entries, you would then post your closing entries.